Hello guys, welcome to our channel. In this video, we are going to talk about the two type of analysis used in stock market trading and investing. So if you like the content, hit the like button and subscribe to our channel. So there are basically two types of analysis used in stock market. The first one is fundamental analysis. Fundamental analysis is a method of evaluating a company's financial health to determine whether its stock is a good investment or not. It actually deals with the study of its cash, the company's cash flow statements, balance sheets, and income statements. Fundamental analysis helps the investor to determine whether a stock or a share trading in the market is undervalued or overvalued. For example, if the market value is greater than the market price of a certain stock, then this is considered as undervalued. Okay, but if the market value is less than the market price, then this is considered as overvalued. Now, let us consider some factors that help us in determining the fundamental analysis of a company or a stock. Number one being balance sheet. In balance sheet, we check its quarterly growth. As well as year-on-year growth of a particular company. Okay, the higher the growth ratio, the higher the growth percentage, the higher potential of getting better returns. The second thing being debt. Right, lesser the debt, better and strong are the fundamentals. The third thing being ROE. It is nothing but return on equity. Now, how does ROE is calculated? It has a simple formula which is nothing but net income of the company divided by average equity of shareholder. Now, more the ROE of a particular company, the better its fundamental and there is a better chance of getting returns. The fourth one being PE ratio. Now, PE ratio is calculated by market price of the share divided by earning per share. Okay, so this is the formula of PE ratio. Now, it is considered a stock with a PE ratio below 20 is a good investment. Okay, if it's higher than 20, let us say 30 and 40, it means it is already overvalued and the investors are willing to buy it 30 to 40 times above its market value. But if the PE ratio is too low, let us say for 5 or 3 something at this point, this also doesn't make for a good investment. It means that the stock doesn't have much value, the stock doesn't have a better future, so no one is interested in it. Right. So the next thing, we have to also consider the pattern of shareholders. Okay. Now in every stock there will be a promoter, then there will be investment of FIIs, then there will be investment of DIIs on mutual funds and others. Others include big investors or retail investors. See, the greater, if the promoter's volume, if the volume of the promoters is above 60, then it means it has a strong fundamental, basis to invest in. Because see, if the promoters are only selling their stock, then who wants to buy it? Right? So as long as the promoters are in the market, as long as the promoters are in the play, that means the stock or a share has a strong background to buy. Okay, you also need to consider that there is a considerable amount of FIIs and DIIs. Okay, so this is the pattern of the shareholders that you have to keep in mind while investing in a stock or a share through fundamental analysis. Now let us talk about the second type of analysis that is available in the market, which stock traders and investors use to invest or trade in the stock market. That is nothing but a technical analysis. Technical analysis is a way of analyzing a financial asset such as stocks through its historic price movement to predict the future movement and trading opportunities in the market. Investors and traders use charts and patterns and historic volume data and price data to come up with the better trading opportunities. This is what is done in technical analysis. Now let us talk about certain factors that are used in technical analysis. Okay, the first one being trends. Okay, so there are three types of trends. One is a bull trend or upward trend, right? So for example, if the market is having a consistent growth in the market in its way, then it is called as a bull trend. Okay, so you can see the market is going up, so this is called as a bull trend. In such a trend, investors or traders opts to buy the stock and keep it for a time till the trend exhausts. The second trend being bearish trend or downward trend. So if you see a constant decline in the market, right, so this comes under a bearish trend where the market is on a constant decline. Here the traders wants to sell their position and earn money through selling. Okay, the investor doesn't want to invest in a bear trend because there there has been a concentration of supply. Okay, so this is called as bearish trend. Now the third one being consolidation or else range bound. So if you see a trend which is neither going up nor going down, okay, it is hitting the same old highs and prior lows, then we call it as a range bound trend or a consolidated trend. So these trends help the traders to determine the movement of the market at a particular time. Okay, the next thing that helps investor or a trader in technical analysis is nothing but support and resistance. Okay, for example, if I take a ball and bounce it off this floor, it can go as high as the ceiling of this roof. After that, it will hit the ceiling of the roof and definitely it will come back, and the lowest it can go is again the floor of this room. So this tells us that the floor is the support of the trajectory of the ball and the roof is the resistance. Okay, for example, if a certain stock is having a trend, okay, and it is not going past 100 and it is not going below 90, then this 100 becomes the resistance of that stock and this 90 becomes the support of that stock. But once the stock crosses 100, it has a high potential of giving higher returns. But if once the stock has been crashed below 90, okay, it has a potential of going even low. Okay, so this is the concept of support and resistance. Resistance happens when there is a concentration of demand, and the support happens when there is a concentration of supply. Okay, now the third thing that helps traders or investors in technical analysis is nothing but candlestick patterns. Okay, there are many candlestick patterns in which I'll give you some of them, which is let us say if you there is a hammer. Okay, and then again there is an inverted hammer. Okay, so these are certain two bull what do you call examples of two bullish candlesticks. Okay, now then if you consider another this thing in the bearish candlestick that will give you indication of a fall or a bear movement. Okay, you can consider a hanging man, right? And again you can consider this shooting star, right? So these are an indication of example of bearish candlesticks, and these two are examples of bullish candlesticks. Okay, then again the next thing that's helpful in technical analysis is nothing but chart patterns. There are various types of chart patterns. I can give you just a few examples. It is a rising wedge, then there is a falling wedge, then you have a bullish rectangle, again you have cup and handle. So these are some of the chart patterns that traders or investors use to determine the upcoming market position. Okay, the way the trend the market is gonna go. Okay, so now in this video we have talked about the types of analysis, that is fundamental analysis, and what are the factors that support fundamental analysis, and then we have talked about technical analysis and what are the factors that are used in technical analysis. Okay, so if you like the video, please subscribe to our channel.